Planning to start a freight brokerage? You might want to think twice. Not because you shouldn't do it. It's because there's a real gap between what this looks like from the outside and what it actually costs. And that gap is exactly what this video is for. The pitch sounds almost ideal. No trucks to buy, no warehouse to lease, work from a laptop, and a market moving toward $85 to $94 billion, matching companies that need freight moved with carriers who move it, keeping the spread as profit. Here's the number that actually breaks new brokerages, and it has nothing to do with licensing. The shipper who hired you typically pays your invoice in 30 to 60 days. The carrier who physically hauled that freight wants paid in 15 days, sometimes immediately. You're on the hook for that entire gap, in cash, for every single load, until the shipper's payment finally arrives. And starting in January of 2026, federal regulators began real, active enforcement against brokers who'd been quietly covering that exact gap by draining the bond they're legally required to keep untouched. So how does a business this simple on paper turn into a cash flow crisis this specific? That's what we're figuring out today. One quick note before the numbers start. Every figure in this video is well-researched and checked against multiple sources. But research can still contain honest mistakes, and costs and regulations shift by state, city, and sometimes zip code. Treat these as your benchmark, not a quote for your specific situation. This video is for educational purposes only and is not legal, tax, financial, or business advice. Always do your own research and due diligence before making any business decision. A second note, specific to this episode. Federal licensing and bonding requirements for freight brokers can change, and enforcement priorities shift. Verify current FMCSA requirements directly before making any decision based on this video. The first cost, the one that looks almost too easy on paper, federal licensing here is genuinely simple. That simplicity is exactly what gets people in trouble. Becoming a licensed freight broker requires federal operating authority from the FMCSA, the Federal Motor Carrier Safety Administration, plus a surety bond of at least $75,000 held in reserve specifically to guarantee you can pay carriers and cover claims. Compared to almost every other business on this channel, that's a remarkably low, remarkably fast barrier to entry. No trucks, no warehouse, no physical inventory. Just licensing, a bond, and a laptop. That low barrier is precisely why the industry saw a real flood of new brokers during the pandemic-era freight boom. Then the market corrected sharply in 2023, and a large share of those same brokers didn't survive the correction. The lesson isn't that licensing was too easy. It's that licensing was never the real test this business gives you. The hidden trap, the one hiding in the calendar between two invoices, you're not just brokering freight. You're personally financing the gap between when you get paid and when you have to pay. Here's the mechanism precisely. A shipper you land, especially a larger corporate account, typically pays on net 30 or net 60 terms, meaning the invoice you sent might not get paid for a month or two. The carrier who hauled that load doesn't operate on the same clock. Independent carriers commonly expect payment within 15 days, and many demand it immediately through a quick pay advance, sometimes for a small additional fee. Run that gap across real volume. A brokerage covering just 20 loads a week, carrying that same payment lag on each one, needs tens of thousands of dollars in rolling credit just to keep paying carriers on time while waiting on shippers to pay the brokerage. Days Sales Outstanding, DSO for short, the average number of days it takes to collect payment, has become the single metric separating brokers who survive from brokers who don't. It's no longer a background number. It's a genuine survival factor. This is exactly where that surety bond becomes dangerous instead of protective. Starting January 16, 2026, the FMCSA began real, active enforcement of that $75,000 bond minimum, specifically targeting brokers who'd been quietly depleting their bond to cover operating shortfalls created by this same payment gap. What was meant to be an untouchable safety net had become, for some brokers, the last source of cash keeping carrier payments current. The real engine, the one that has nothing to do with finding more loads, managing the calendar, is the actual skill this business rewards. So if new loads aren't the constraint, what actually separates a brokerage that survives from one that doesn't? Working capital discipline, treated as seriously as sales. Brokers who actively manage DSO, chasing shipper payments promptly, and structuring contracts with realistic terms up front, keep that cash gap small enough to fund from real operating capital, instead of a bond that was never meant to cover it. Factoring, selling the right to collect an invoice to a third party for a small fee in exchange for immediate cash, is a real, legitimate tool serious brokers use specifically to close this gap without touching their bond or personal funds. 2026 itself is shaping up as a genuine test of exactly this discipline. Industry watchers describe it as a leaner, more professional market, fewer brokers than the 2021 boom, tighter capacity, and shippers actively returning to brokers who can prove they run a tight, well-capitalized operation. That's not a coincidence. A market that just watched thousands of undercapitalized brokers fail is exactly the market that rewards the ones who treated cash flow timing as the actual core competency, not an afterthought behind finding the next load. The real money in freight brokerage. The margin on the load was never the hard part. Surviving the 30 to 60 days between paying the carrier and getting paid by the shipper is. Master that calendar, and this business's low barrier to entry finally becomes an advantage instead of a trap. The 2021 to 2023 cycle is a real, documented case study in exactly what this video has been describing. During the pandemic freight boom, low barriers to entry meant, in one industry veteran's own words, that it felt like everyone with a laptop and a load board became a broker. Volume was high, margins were forgiving, and the payment timing gap this video covers was easy to paper over with easy money. Then the market corrected sharply in 2023. Thousands of those same brokers didn't survive. Not because freight stopped moving, but because the cash flow discipline the boom years let them skip suddenly became the entire difference between staying open and shutting down. The brokers describing 2026 as a genuine comeback opportunity aren't talking about easier margins. They're specifically pointing to fewer, weaker competitors left standing, precisely because so many of them never built the working capital discipline this business requires. So let's run the two real outcomes. The optimistic case. You secure a real working capital line or factoring relationship before you need it. Track DSO as closely as any other business on this channel tracks its central operating number, and treat the surety bond as untouchable exactly the way it's legally meant to be. Cash flow stays manageable even as volume grows. Carrier relationships stay strong because payments are reliably on time, and the business scales on real capital instead of a bond it was never supposed to depend on. The realistic case. You launch with minimal working capital, assume the margin on each load is the whole story, and start quietly dipping into the bond the first time a few large shipper payments run late at once. Carrier payments slip, relationships sour, and the exact federal enforcement this video described becomes a real, direct threat to the business's ability to keep operating at all, on top of the cash crunch that caused it in the first place. Same loads, same margin per shipment, same market. The entire gap between those two outcomes comes down to whether working capital was planned for on day one or discovered the hard way the first time a shipper paid late. So is it worth it? If you're picturing a simple margin business you can run from a laptop, that part is genuinely true. What's not pictured is the calendar working against you on every single load until you build real capital to fund it. What's true is that this remains a genuinely low-barrier, real-margin business in a market that's actively rewarding disciplined operators right now, for owners who respect the cash flow timing as much as the sales pipeline. For someone willing to secure real working capital and treat DSO as a survival metric from day one, this can be a strong, scalable business in a market with fewer serious competitors than it had a few years ago. For someone assuming the margin alone carries the business, The federal government started enforcing exactly the consequence of that assumption in January of 2026. Last reminder, FMCSA licensing, bonding, and enforcement requirements can change. This is not legal or financial advice. Verify current federal requirements directly before making any decision based on this video. Remember this: nobody fails this business because they couldn't find loads. They fail it because they couldn't survive the calendar between paying the carrier and getting paid by the shipper. Fund that gap before you need to, and the rest of this business is just relationships and math.